Welcome back. The Monetary Authority of Singapore sounds caution over Singapore's economic growth for next year. That is, even as it kept monetary policy unchanged, given better than expected performance in 2025 so far. Still, experts say that MAS is keeping the door open for a possible third round of easing in October. Nashra Rohim with this report.
After easing monetary policy twice earlier this year, the central bank left settings unchanged in July, citing resilient global economic growth in the second quarter. It also points to the Sing dollar's appreciation against several other major currencies that has kept imported inflation low. But one analyst says Singapore is not out of the woods yet.
We will see very, very subdued headline growth numbers on a year-on-year basis. We could potentially see 1 quarter of a sequential quarter-on-quarter contraction. It really all depends on the outcome of the tariffs situation and basically how that actually affects, business sentiments. We have seen that, SMEs in Singapore, for instance, are a little bit concerned about the potential pullback in terms of external demand and how it will impact, Singapore big companies as well.
Trade-related sectors like manufacturing and wholesale trade are particularly at risk looking ahead. They've had a pretty good run so far this year, and that's mainly due to advance orders and transactions. But this trend will likely fade going into the next year. And along with uncertainty circling around US tariffs on trade partners, analysts say that business sentiments is getting bleak.
The impact on Singapore businesses and economy would also depend on US tariffs on partners that Singapore is linked to, for example, China. So while there's a de-escalation on that front, the environment is still one of still high tariffs compared to before Trump came into its second administration.
On the employment side, as firms hold back on expansions, MAS says the demand for workers could continue to soften over the second half of this year. And that greater slack could emerge if the growth slowdown turns out to be deeper and more protracted than expected.
And we have an expert in the studio to help us make sense of the figures. Dr. Tan Kee Wee is Principal Economist at Waveney Economics. Dr. Tan, welcome to Singapore tonight.
Good evening.
So we hear of uncertainties ahead, right, from tariffs and the possibility of global shocks. Pretty much the story since the beginning of this year. But in your view, what has changed for Singapore?
Well, it has gotten worse. Okay, first of all, the tariff was unexpected to not only Singapore, but to the world. Right now, it is going to be 10% from August. But there are a lot of uncertainties. We don't know whether certain products will be taxed, like pharmaceuticals and electronics, because electronics is a big part of Singapore's GDP, about 30%, and farmers about 8-9%. So at this stage, we don't know. Our DPM went to US recently and came back, he's not much clearer on it. Yeah.
Given Singapore's heavy reliance on trade, how resilient is our economy to such regional conflicts or shocks, with the recent flashpoints such as the Thailand and Cambodia conflict? Okay,
of course, that's not positive for us. You see, when the US shuts its market to the rest of the world, what the world is trying to do, or has been trying to do, is to trade among ourselves. When Thailand and Cambodia quarrels, they are part of the Belt Road Initiative. And if there is trouble there, they're probably not going in the mood to buy things from the neighbors and from us. So, of course, some people say that that is the result of some CIA job, but we don't know.
Yeah, we'll never know, right? For Singapore, your prediction on the tariff situation, can we actually expect to stay at the baseline of 10%? And how much influence does Singapore have, or realistically have, in shaping these negotiations with the United States?
I think we're quite weak. First of all, we have already an FTA with the US, and that's supposed to be zero tariff. But, of course, they decided to impose 10% on us, and there's really nothing we can do. And given the unpredictability of the administration, we don't know going forward what else they're going to do. But you see, the thing is, between Singapore and US, we actually have a deficit with the US. Now we sell less to them than they to us. So they should treat us well, but they are not. So actually we are at the short end of the stick.
So if you are a business operating in Singapore, selling to the US market, what risks would you be most concerned about right now? And what sort of measures or concrete steps would you recommend for these businesses to take on?
Okay, just look at all the big things that we sell to the US. Mechanical equipment, electronic equipment, optical equipment, even aerospace equipment, and even chemical from our petroleum industry. Now, all this will face 10% from August. Now, I mean, what can you do? I mean, of course, all countries what they're trying to do is to find alternative markets. And if, let's say, you are not even in those industries that I've just listed, you are dependent on them. For instance, if you sell food to the firm that sells aerospace products to the US, when they can't sell, then you buy less from the food companies. Food companies will be affected. And if he's got customers from Malaysia and they are also affected, then they will also be buying less from this food company. So everyone will be affected. Yeah.
So what advice would you give these businesses to prepare for those risks?
Well, I think everyone has more or less been getting ready for it. There's not much they can do. I'm sure they're trying very hard. Businessmen are usually the smartest around. You see, it was announced in April, right? And between April and now, July, everyone has been trying to export ahead. Do you know what I mean? So to beat the deadline. So they've all done that, and that actually explains partly why our GDP has been better in the second quarter.
Okay.
Yeah.
All right.
But going third quarter, we don't know.
Okay. Yeah. I want to revisit the numbers again because we hear the word effective tariff rate, which is now at 8% for Singapore compared to something closer to 7% in the last quarter. What exactly does this figure mean? And should we be concerned that it has now gone up?
Well, actually, there's one good reason. The US imposed 25% tariff on exports of steel and aluminum from Singapore in February. Then in June, they increased again another 25%. So the tax on steel and aluminum is now 50%. Now, but the exports of steel and aluminum from Singapore to the US is very small, about 4% of total export. So the effective tax rate has gone up from actually 6.8 to 7.8. But come August the 1st, we put in another 10%.
Right. So would you say that we should be concerned?
Yes, we should be concerned. I mean, to give an example, not everybody knows this, but Singapore exports about $300 million worth of chocolates to the world. And the biggest buyer is the US market. Okay? Now, with this 10% tax, what are you going to do? If you're the chocolate factory, you have to quickly look for another customer. And if you can't, then you're fixed.
All right. It's all about diversifying and finding alternative markets, right, Dr. Tan? Thank you. Yeah.
That's not, I mean, there's sort of good side to it. See, Singapore's tariffs are only 10% compared to our neighbors who are much higher. Now, the good positive spin to the story is that other countries might find, hey, it is quite attractive to maybe base their operations in Singapore. Just like, a lot of Chinese companies are here in Singapore because they want to be in the middle of the US-China fight.
Right.
TikTok is here, right? Things like a lot of Chinese food companies are here. They are preparing. And so this, our lower tax rate of 10% could actually attract. So it's not all bad news.
It's not all bad news.
It's not all bad news.
Thank you so much. Appreciate your insights tonight, Dr. Tan.
Thank you.
That was Dr. Tan Kee Wee, founder and principal economist at Waveney Economics.